It's all a question because every time people ask me when would price move, and they would say, oh, sometimes I took a trade and price move against me. Why does this happen? And trust me, I got you on this because it's all about liquidity. A lot of you guys think the banks trade like the way you and I do. They sit down from day to night watching the chart, trying to predict where the price goes to, trying to analyze indicators. But this is wrong. They don't trade the way we do. They trade using liquidity. And if you don't understand liquidity, best believe you are the liquidity in the Forex market. My name is FX, a Forex trader with almost half a decade trading experience. And in today's video, we'll be talking about some few things that will change your game a great deal if you understand them. By the end of today's video, you would know exactly why the institutions trade the way they do using liquidity, areas where retail traders get lost or get stuck trading the Forex market, and how you can avoid that. So if you're new to the channel, it's important you like the video, subscribe, and let's go. Okay, so liquidity. The question you're going to be asking me right now is, what is liquidity? Let's put it down in a very basic concept you understand. So liquidity simply means cash. Some other people, they will tell you it is cash waiting to be introduced in the Forex market, but generally it means money. Now, for you and I to do business in the Forex market, we need to make profit. Now, this is where the concept of liquidity came about, where people do business online in the Forex space with the aim of making profit and at the end of the day, and they need liquidity to do this. Now, whenever you and I come into the market and we click on the buy or the sell button, we introduce liquidity in the Forex market. However, we're trying to avoid something while we trade. We're trying to avoid being liquidated, and this is why this video is important to you. Now you understand the concept of liquidity, you understand how it goes about. Now, it may be vague for some of you guys who are probably new, the newbies, so let's put this in a way you understand even better. Imagine you want to buy in the Forex market. You need people to sell to you. Now imagine you're in a normal market where you buy your groceries, you go get sugar, whatever it is you want to get. You want to buy, you need people to sell to you, and you want to sell, you need people to buy to you. Now this is how the concept of liquidity came about in the Forex market. That's just it, simple and straightforward. The next question is, how do institutions use liquidity? Let's start afresh. Imagine you're trying to catch a rat. The first thing you're going to do is to go get a trap and put some cheese on the trap, trying to lure the rat closer, and then you get the rat. Now, it's the same concept with how institutional traders use liquidity. Now, let's put this in a way you understand better. Imagine you click on a buy in a given day, seeing price close above a particular breakout line with a marginal candle. The first thing you want to do is to click on buy, and best believe I will do the same thing. I mean, I've done this over and over again in the past without even minding where it is I want to take trades from, if I'm trading with confirmations or not. I just want to click on the buy or the sell button. But here goes. This is one thing the institutional traders want for you. This is one thing they want for me. They want you and I to trade blindly so they can make money from our own liquidity, the liquidity we introduce in the market, and at the same time we become liquidated. So take for instance, you saw price going in a particular direction, candles are looking all bright, the chart is looking all cool, it's a Monday morning, you want to take a trade, the London session, you're good to go, and you came into the market, you found out that price closed above a particular resistance, a breakout strategy you want to trade with. You click on the buy or the sell button, and immediately price reversed back and starts going the opposite direction. This is done by institutional traders. Now, institutional traders trade a huge account size. They introduce huge liquidity in the market. This means they could buy more and they could sell more. Now, for them to have transactions that are completed, they need more liquidity. So one thing they do is they introduce a little amount of their liquidity in the Forex market in the direction you originally want to trade in, and you're excited, you're happy, you just want to click on the buy or the sell button, and immediately you do so, price reverses back to the original direction it was supposed to go. Now this is the case of you catching a rat using cheese. Now that's exactly what institutional traders do every time they trade. Now the next question is, where do they get their liquidity from? Calm down, let me explain. You see, those areas where it seems very obvious for you to place trades, those are the exact areas where they get liquidity from. You see, those equal highs, the equal lows, the triple bottom, whatever, right? These areas are where banks, institutions get their liquidity from. Now, they also get liquidity from structural lows. Those areas where you originally want to put your stop loss at, those are the areas they get liquidity from. And as a trader, you must be careful of those areas. The question is, what are the mistakes real traders make that make them end up being liquidated? Number one answer, they trade without confirmations. You see, a lot of you guys want to trade the forex market and you quickly dive into the market, spotting up a structural break or whatever, and you quickly click on the buy or the sell without having a confirmation of what's going on in the forex market. This is the exact reason why you keep getting stuck out every time you click on the buy or the sell button. So one thing you want to be doing as a forex trader is, at any point in time you want to trade the forex market, it's important you ask yourself a question, right? Where am I putting my stop loss at? That's the first question. What is my confirmation? Is it confirmed that I should go into this trade right now? Right, that's the question you want to be asking yourself. So it's important to ask those questions. The next mistake a lot of retail traders make is the fact that they go on to trade breakout. I was once in your shoes, guys, so I know how this feels, I know how this works. You just want to trade because you're excited, because of some of the few things you think in your mind you're going to be making at the end of the month, at the end of the week. And this make you make rash decisions without proper considerations of how things is going to end up should in case you take losses. And that's the exact reason why you lose money trading the forex market. You see, institutions are not there to trick you, to make you feel bad about yourself. They are there to make profit just like you and I. And the sooner you understand that institutions use liquidity, the better for you, because this helps you align your thought process to a different spot where you're not trading like a retail trader, but you're not trading like the way the banks would trade. In closing, liquidity in itself means cash, just like you already know. The question you start asking yourself is, how do I use this? Because I believe when you ask better questions, you get better results. It's all about asking better questions. So that's it for today, guys. I'll see you in the next video. Before we go, we want to know what you think about the video. We also want to know where you want us to help you and the next video you would like us to talk about. Just comment below and we'll surely gonna respond to you. Alright guys, see you in the next one. Bye for now.